The S&P 500 index has posted exceptional returns for the past 2 quarters. But what has been driving those returns? It turns out that most striking contributor has been the dominance of the 7 largest stocks in the US, the so-called Magnificent Seven: Amazon, Apple, Google, Meta, Microsoft, Nvidia, and Tesla. These companies alone made up 33% of the total value of the S&P 500 as of the end of March. And if you were to exclude them from the index, the returns would have dropped from 10.6% down to 6%. In fact, over much of 2023, these few stocks were flying high and were the darlings of the market. Nvidia alone increased by 239%. Over the same period, the S&P 500 was only up by 26%. It's at this point many investors may question the validity of a more diversified approach. Why settle for 6% returns when if you just pick the right stocks, your returns could be much higher? The simple answer is that it's harder than you might think. You have to know which stocks to pick, you have to know when to buy them, when to sell them, and you have to be willing to accept a lot more volatility once those decisions are made. If we take a look back, most of the Magnificent Seven incurred double-digit losses in 2022. Nvidia, again as an example, was down by negative 66%. By comparison, the S&P 500 was down just negative 25%. While they may be soaring now, just 2 years ago, people were bailing out of these shares with seemingly no bottom in sight. Going back a little further, all eyes were on the FanMag stocks: Facebook, Amazon, Netflix, Microsoft, Apple, and Google, as they outperformed the S&P 500 throughout much of the pandemic. And now looking at this last quarter, we saw top performers like Tesla down negative 26% and falling out of the largest 7 US stocks. All these fluctuations illustrate how rapidly today's darlings can turn into tomorrow's ugly ducklings and remind us that it's impossible to predict short-term market performance. As investors, we expect that volatility is part of the trade-off one endures to achieve higher returns. You can't have one without the other. There is a point, though, where that risk goes from prudent to speculative. Narrowing your holdings by investing in fewer companies will increase that likelihood that things can go wrong. But broadening your portfolio and becoming more diversified allows you to spread out your risk, reducing the chances of a bad pick ruining your financial situation. Rather, it greatly increases the likelihood that you will reach your desired outcome, financial freedom. The discipline of diversified investing rewards the patient. We would rather generate a reasonable return over time with a reasonable level of risk than take outside risk with a lower probability of obtaining a return that will help you achieve your financial goals. By embracing the principles of long-term diversified investing, investors not only safeguard their financial future, but also cultivate peace of mind amid fluctuations. In the journey towards financial success, patience and prudence pave the way for lasting prosperity.